Last Friday, China's central bank announced a cut in reserve requirement ratio of banks by 1%. This means banks will have more cash to give out as loans. The cut is expected to release around 1.5 trillion yuan into the economy, which is aimed at helping small and medium-sized companies as the Chinese economy gears up for a soft landing.
Chinese market watchers are no stranger to what they call the Triple R cut. Last Friday, China's central bank announced its latest round of reduction in the amount of cash that all banks have to hold as reserves. By lowering the reserve ratio by 1% in 2 stages throughout January, it's set to inject 1.5 trillion yuan, or $219 billion into the lending market, which is expected to make banks more willing to give out loans to small and medium-sized businesses. Since last year, China's central bank has slashed the Triple R rate 5 times, and the market expects more cuts on the way. Last December, the Chinese government pledged to carry out a monetary policy in 2019 that is neither too tight nor too loose, and this Triple R cut is seen as part of that effort. In a statement at the 2018 Annual Central Economic Work Conference, China's top officials say while achievements are plenty, the country's economy faces downward pressure. To turn pressure into fuel, policymakers outlined a series of priorities to upgrade its economic structure. They include stabilizing the financial market, lessen the burden for taxpayers, raise special-purpose local government bonds, cut down low-efficiency zombie state companies, strengthen high-quality manufacturing, speed up the growth of the service industry, improve living standards in the countryside, and stick to opening up. Last December, the government decided to open up new sectors to foreign direct investments nationwide. The new negative list for market access, much shorter than before, makes it a norm for foreign funds to invest directly in the Chinese market instead of an exception. Amid slowing growth, 2019 is a key year for the country to achieve its goal of becoming a moderately prosperous society by 2020. As Beijing and Washington buckle down to trade talks to ease external pressures, the Chinese government also lost no time fixing domestic concerns.
For more on China's plan to boost the economy in the United States, we have Professor Chris Versace, who is the Chief Investment Officer at Thematica Research, in fact, and also joining us in New York, Max Wolf, Professor at the New School University in Beijing studio, Jay Huang, the founding partner of J-Stone Capital, who's also the former managing director of Intel China. I want to welcome the 3 of you, gentlemen. I want to start by asking you, Professor Wolf, if you look at the Chinese economy growth rate likely to come down this year, 2019, there is debate both inside the country and overseas about what to do with it. Some say China really needs to maintain certain growth rate. Others say structural reform is even more important. Professor Wolf, given the current circumstances, what would you say?
So great to join you, and Happy New Year to you and your audience.
Thank you, sir.
Look, I think that we understand that China has had one of the longest runs at one of the highest rates of growth we've ever seen, and we've actually had to remake our rules to make sense of the economic growth rate and the sustaining growth rate that China's experienced. So I think we have to keep in mind and be humble that we're in new territory here, and so it's with some trepidation, some humility, that we should make the prognostication. That being said, the bigger job for China than 1 year or 1 quarter or 2 or 3 years growth is to transition into a mature, developed, high-income country from the most successful of the middle-income countries, which has been a long journey that's now well underway. That has a structural reform base in it and also an economic growth rate. Clearly, we're going to see some weakness in the total global growth rate. So Japan, China, even the U.S. likely to slow this year and to be below target. So China is very much within the global pack there. But there's going to be an extra weight, an extra pressure on this transition because of the sudden deceleration around trade and deglobalization. I think the bigger issue for China than the growth rate is the bigger issue for the whole world than their growth rate, which is we have now the former architects of globalization in the West, in some cases becoming advocates for deglobalization, and that's the bigger risk.
Well, that probably is about the ideas, but what about if you look at the economic figures? Mr. Huang, sitting here in Beijing, China has already started its ways of trying to boost the economy. This time, not the stimulus package, but rather bank ratio reserve lowering 100 point rather, and therefore unleash all these potential for companies, particularly small and medium-sized, to borrow. But the question is, how is this policy, together with others, likely to work on the really grassroots companies?
I think the intention is correct. As you correctly pointed out, and the banks have more money to lend, so the small and medium-sized enterprises can borrow more. But the precondition for the small and medium-sized enterprises to borrow money is to expand their business. So the precondition is their business has to make money so they can expand it. If their business is losing money, it makes no sense. They borrow the money to expand the money-losing business. So it's very important, for the small and medium-sized company, they can make money. So the government need to do more than just lower the bank reserve and the ratio, and also should considering other measures such as lower taxes.
Lower taxes to what extent? That's, of course, is another issue over there. Later, we're going to discuss that. Mr. Versace, what do you say?
Well, I think when we take a look at what has happened with the cutting of interest rates, this is very much in line with the playbook that we've seen both from the U.S.'s Federal Reserve and the European Central Bank trying to boost their economies as they slow. And when we look at the data last week from IHS Markit for the December PMIs, we saw that China's economy was, in contraction mode, both from the overall headline PMI figure as well as the new orders, which would suggest, a continued slowing, or at least another month of contraction in January. So it's not surprising that we would see China cut their interest rates. To me, it's the degree of the interest rates cut that we did see. That seems to signal almost as if the Federal Reserve were to cut not a quarter point or a half a point, but almost a full point, that China is extremely serious about jump-starting its economy, whether that's to small, medium-sized businesses, also reducing the cost of borrowing, not just for businesses, but for consumers as well. So I think it says very serious.
Right. Professor Wolf, of course, this time lowering the bank reserve ratio 100 points is only part of the policies that you have seen over the past 1 to 2 months. The Chinese government and also different departments of the Chinese government certainly have put out a number of policies. For example, in December, late December, the new negative list of investment has been put out there, suggesting what investment people can do. Earlier, there was debate about the list that was too vague, and now China certainly has put that out. I'm not sure whether the international press really have been studying that, and you see very little reporting of it. Meanwhile, you also see reform and opening up measures taking place, issued by different departments. For example, NDRC, Commerce Department, and some of the others. So, Professor Wolf, on the one hand, China is having a basket of policies putting out gradually over the past 2 months. On the other hand, do you think the world market has really received the message? That is probably another issue.
No, I think that the world market has been fixated on the 90-day extension and the idea of a potentially escalating series of trade disputes between the United States and China, and that between that and the sort of occasional rapid shift in policy from the American administration here that has taken up most of the bandwidth of a lot of the news organizations. I do think there's a general global consensus that the rate of economic growth in China has slowed, and then there's a huge debate as to whether that's part of this longer process of changing the structure of the economy, liberalizations, and also shifting toward a focus on the Chinese consumer from the global export market, or whether it's due to the tensions and the global disturbance created by new anti-free trade measures, particularly but not exclusively taken by the U.S. So I think there was a big distraction. I think we are also trying to sort of read the tea leaves of what the best positioned individuals inside the Chinese decision-making apparatus, what they think is coming for their economy, and the more aggressive their policy measures usually kicks off a debate about what that means about growth 1, 2, 3, 4 quarters out.
Mr. Huang, one of the key things that the Chinese are facing right now is about the debt issue, of course. The debt issue is not just the debt coming from the banks to the companies and the local government, but also the debt that the Chinese companies are borrowing in U.S. dollars overseas. So how do you see now? It seems that the latter is rather a newer phenomenon, particularly the piling up of that is a newer phenomenon. So, Mr. Huang, I know you've been trying to invest in different kinds of new technology projects all over China, going to different localities, talking to people. What's your sense of this combination? Because it's kind of new in a way.
Yes, you're right. In terms of all the government debts and also the enterprises debt, if we trust the statistics, the statistics says it's still in a controllable level, and we shouldn't be alarmed. However, and we don't know if we can fully trust the statistics. In terms of borrow the money in the U.S., I think that's a good thing. And if we can borrow the money in the international market, that also says, and then we have a pretty strong the credibility and the international markets and look at the China's economy and with the confidence. That's why they would like to lend money to us. That's maybe another indicator. Our overall debt level is not too bad, as some people speculated.
Well, you're answering it in an indirect way, Mr. Huang, but to you, Professor Wolf, as an economic professor, how do you see that, the combination of both debt within the country and also borrowing in debt in U.S. dollars overseas? Because now, you know, the dollar vis-a-vis the RMB is changing all the time, as we know.
Right, so dollar policy has become a little bit unhinged from its historical track, and if you borrow in dollars, you also have currency risk, right, FX or currency risk, because you'll have to repay those loans in dollars. So should you have an adverse move in the renminbi, in your local currency, then those loans become instantly more expensive. And also borrowing from international organizations give you a little bit more direct risk from them, and borrowing from domestic savers, which has historically been a source of abundant, inexpensive capital, largely inside China, also makes it a national story. So in an age of deglobalization, adding foreign and FX risk is not always a great idea. On the other hand, companies, particularly facing a lower growth rate, need to find efficient sources of capital that are cost effective. And having borrowed outside the country often gives you access to global markets, whereas if you need to export the capital from the country, then you can get entangled in various export or capital flight controls at some points.
Mr. Versace, we've seen in the world there has been a lot of celebration of new technologies, of AI, of robots taking the place of the current laborers. But on the other hand, the economies worldwide have not necessarily seen the growth rate as well as the quality of growth necessarily linked this time to the development of the technologies, and many contribute that to the geopolitics and the trade wars going on, not just between China and the United States, but also U.S. and some of the other players it has in the world. So are we going to see a lack of growth on a global basis despite real jump or real leap in technologies? That would be one of the rare occasions if we compare to the past 20 years of development. Mr. Versace.
So it's actually a very interesting question. You know, what you're talking about with these different technologies, at the heart of it is productivity. Productivity is, of course, one of the key factors in driving GDP, whether it's in the U.S., China, or anywhere else around the globe. I think we have to think about a few things, given where we are with AI, robots, and the like, that, despite the headlines, they're still relatively small percentages. They are growing, and I think they'll have a more disruptive impact over the next 2, 3, 4 years than they've had over the last 2 or 3 years, without a doubt. As far as the rate of growth that we're thinking about, remember here in the U.S. that 2018 was a little bit of an anomaly in the sense that we had the one-time benefit from tax reform that really cut tax rates, allowing companies to free up capital and to invest. We don't have that added bump going into this year. So from an earnings perspective for companies, there's not going to be as much of a dramatic impact. But I think that when we take a look at what's going on this week at the Consumer Electronics Show in Las Vegas, we'll see a number of new products, a number of new technologies that will be hitting not only customer shelves but factory floors, not in 2019 but 2020, 21, and I think over time these disruptive technologies will indeed drive not only greater productivity but foster a new type of job demand for a skill set that is very different than what we've seen in the past.
Mr. Huang, of course there's always a benefit of new technologies, but this time we haven't seen that really nurturing the growth rate and the quality of growth yet.
Technology development definitely can boost the economy, but they come in within their own cycles.
Right.
Take mobile communication as example. People nowadays talk a lot about the 5th generation, 5G, but if you look back in history, every generation, the new generation will come in for about 10 years. So it's too early for us to see the 5G benefit and in the next year or two. But they all have their own cycles, and they definitely in the right time will come to help boost the economy.
So here's the thing, Professor Wolf. I mean, you got the world economy not necessarily growing at an impressive rate, and people are concerned about certain things, geopolitics included. Secondly, you got some of the major economies apparently in a trade war. Thirdly, you also do not see technology right now is going to play the pivotal role in boosting the economy. The question will be, what can we rely on for growth worldwide? Of course, the U.S. is doing very well last year given a package of policies for stimulus. But what about this year? Even though the U.S. could grow, what about the rest of the world? And when it's not such a connected world when it comes to trade, what can we hold on to for growth?
So, I mean, one of the things I think we'll have growth from will hopefully be a resolution to some of the self-inflicted wounds that we have in the global economy here revolving around the trade disputes. Then the other thing is, if I would politely beg to slightly differ, I do think we have gotten the stimulus from the new technologies, the AI and the robotics. I think they just came into a depressed economy. And I think that the economy has come and will be for the next 5 years very dependent on the global political situation. So around the world, we've sort of seen a lot of buffeting around of the norms, shifting around populists being elected and general publics being unhappy. And I think the challenge of the next 5 years is to have a little more distributional equity in the economic growth that will help us to move away from the more disruptive and populist politics. I think that's the great challenge of the next 5 years. And I think if we can do that, get our distribution a little bit under control all over the world, and resolve some of the self-inflicted wounds of the trade dispute, I think that will be our sort of X-factor accelerant to economic growth. And I think also if we get that wrong, we'll see the situation markedly deteriorate from where we are now.
More equal distribution of wealth, but Professor Wolf, what way are you thinking about when you're saying this? Do you see politicians are coming together with other sectors of the society to be able to come up with some common consensus? That we haven't seen yet.
We haven't seen yet, but we've seen the impetus toward it. So I think the chorus of voices from business as well as government and the academy saying that we need to shift the distributional balance. Actually, I think you see it in the policy package being pursued in China right now, and I think you will see it. I think in the initial sort of 2016 moment here in the United States, there was an effort in that direction. So we were going to solve our distributional problem in the United States by accusing foreigners of sapping the opportunity for the lower and middle income groups. When that doesn't work, which it always doesn't, then we'll have to ask more difficult questions. But I think around the world, and whether it's academy, business, or government, that question is becoming the question of the era.
Mr. Versace, your thoughts?
I mean, there are several points in there. I think the better question to get back to is the one you asked about growth going forward. And from our perspective at Tematica, we look at the world at the shifting landscapes of economics, demographics, psychographics. And one of the largest phenomena that we, both in the U.S., and you'll see this also around the world, and in China, is the shifting in demographics towards the aging of the population and the changes that they will foster on various services, goods even, that are needed and required. I think we'll see over the next, not 2 years, but the next 5 to 10 years, a pronounced shift in that as companies look to cater to those changing needs. That, I think, from a micro level, not necessarily a top-down macro level like we've been talking, will be a demonstrative area of growth, and one that your listeners and your viewers will want to pay attention to, and odds are they will see that impact their daily lives.
Right. Before we go, Mr. Huang, your final words too.
I think this unequally distributed wealth, and we have to admit it, there is some reality, which is, in my opinion, the technology development actually contribute to some of this unequal distribution of wealth. This is the reality. We can try to blame on this one to other things like immigration or other things like globalization, but the truth is, technology development does have a contribution. We have to realize that. Unfortunately, we don't think we have a solution for that yet.
Not yet. Jay Huang, Max Wolf, Chris Versace, thank you so much, gentlemen, for joining us. Really appreciate it.